It's time now for our Muni moment. And sales right now of new U.S. state and local government bonds are poised to dwindle for the next few weeks, according to forecasts. The slowdown, it might actually relieve some pressure on munis, which are posting losses this month. Joining us right now to discuss is Christopher Brigati. He's Managing Director of Municipal Investments and most recently was with Valley National Bank. Chris, great to have you here on the program. We've been talking a lot here about sort of the, I guess, drawdown, if you will, in new issuance here. How much longer do you think that's going to last?
I think it's going to persist for some time. Yeah. Probably through year end and probably early in the next year as well. It's usually what really drives the market. Supply and demand is the key. And so watching this happen and watching it unfold is going to be important.
Well, give us a sense here as to why we're seeing that. Is it because the states and municipalities don't need the money, or is it just too expensive to borrow?
A little bit of both. You know, they had an influx of money due to COVID money and COVID relief. And so that's really helped them bolster their savings and help them not need as much money. Do they need the money? They can put it to use. Give them some money. They'll figure out a way to spend it, of course. But it's a matter of, well, that's a question mark. But there's definitely a challenge for them.
Yeah.
So that's the supply picture. Talk to us about the other side of that, the demand picture. What has the demand for these bonds been like amid this pretty light calendar?
It's been pretty consistent and pretty strong. I mean, you know, as the demand has remained steady with lighter supply, it really kind of upticks the overall opportunity for bonds to kind of perform well, which they've done of late. And the question is, when is that train going to run out of steam? And I think there's going to be some opportunity early in the next few months.
And talk to us about the municipal market broadly. When you take a look at muni treasury ratios, for example, when you think cross-asset like that, how does muni demand stack up versus what we're seeing for treasuries?
It's been relatively robust. We're kind of on the lighter end of, the stronger end of the ratios. And what that means is the buyers are participating, they're engaged, they're actually pretty strongly buying into the market on a relative basis. It's not the best overall levels, but they're attractive enough to keep people interested.
I am curious. I mean, we mentioned bringing you in here about some of the returns, or rather lack thereof, that we've seen as of late here. This gets into the idea. I mean, it's late August. At some point, people are going to have to start thinking about how you account for those losses, assuming that they do persist through the end of the year. Do you start thinking about that now, or should you maybe wait a little bit longer to see if some of those losses are recouped?
You know, I think the earlier the better. There's a couple of reasons for that. I think as we head into September, October, it's cyclically a challenging time for the municipal market. And so should that come to fruition, you're going to be able to realize some of those losses, and there will be ample opportunity to reinvest. The problem is you go closer to year end, which is when people normally try to realize those losses. It's a harder time period. There's less supply. There's other challenges that might arise. And so it creates this little bit of a disconnect, and it's hard for people to engage as easily as they could otherwise. Kind of look at it like try to shop for a Christmas gift on December 24th. You're going to have a tough time getting it. You're going to probably pay the maximum price. So you plan a little bit ahead. There's more opportunity to kind of shop a little better, and you can find better deals.
This is what I told Katie last Christmas when she came up empty-handed.
You know, you'll find something. Yeah. It won't be good, but you will have something to wrap up. Talk to us about that reinvestment, though. If you do get a jump start on some of that tax loss harvesting, tax loss swapping, where's the best reinvestment opportunity?
You know, I think right now you can kind of look at it two different ways. I think if you go out into the 20-year space, you can lock in 20-year yields with 4.25 type of levels, which equates about to a 650 taxable equivalent yield. That's really kind of attractive on a relative and an absolute basis, historically speaking. We haven't seen these levels since before 2008. So that's been a long time in coming for this kind of opportunity to really present. The other side is the very front end of the curve. It's really, really attractive with this inversion. It's in municipals as well as treasuries. And so maybe being a little bit more robust in that space, but you can't park it there too long. You will get hurt in the long run if you just wait, because those eventually will come down, and you might miss this reinvestment opportunity further out the curve.